In March 2023, when the government announced that debt funds will no longer enjoy indexation benefits, you had a big question in your mind whether debt fund returns will really beat inflation and whether they will any longer remain tax efficient investments for you. And that's when the question of whether to use hybrid funds as a substitute for debt mutual funds came up. But are they really substitutes for debt mutual funds? And if so, how can you use them and when not to use them? That's what we're going to look into today. Before I dive in, do subscribe to our channel if you like this, and we will ensure that you get regular updates, on various topics in the market, and also empower you with more knowledge on mutual funds, stocks, bonds, deposits, and so on. Let's dive right in. So we have actually written an article for Prime Investor subscribers on this, and I'm going to run you through it because it has enough data. Before understanding, what are the tax benefits or tax disadvantages, let's just take a quick, look at the categories of mutual funds under the hybrid, category as defined by SEBI. You largely have this conservative hybrid fund, balanced hybrid, aggressive, dynamic asset allocation, multi-asset allocation, arbitrage, and equity savings. In this lot, you will find that conservative hybrid fund was already a debt-oriented fund, which means when debt funds lost their indexation benefit effective April 2023, this category also lost indexation benefit. So I'm not looking at it as a substitute in terms of superior tax benefit. So for this discussion, we leave that out. So we are left with the other category of funds, right? When you really start looking at hybrid funds as a substitute for debt, there are a few limitations. And what limitations are they? You should understand that you may be changing the risk profile of your portfolio by trying to substitute, your debt fund with any category of hybrid fund for that matter. The second thing is, there are certain categories in hybrid which will get indexation benefit. But you are basically counting on high inflation, because only when you have high inflation, your indexation, your cost inflation index will grow that much more higher and provide you with the benefit that is needed for lowering your taxes. So you're counting on that. Third, you are betting that tax loss will remain the same for this category as well, right? I mean, you didn't think that debt funds would suddenly be removed off the indexation benefit. Tomorrow, the same can happen to some categories of hybrid funds as well. So when you try to make decisions based on tax loss, you are acting, on matters where you have no control over, because taxation laws are extraneous to your portfolio and things can change. So you must be very aware of this when you are making decisions merely based on tax. I'm not saying you should not, but tax should be one consideration along with several other considerations. And we look at it here. Right, so let's first understand the taxation impact, right? What does, please remember, it is not SEBI that tells you how mutual funds will be taxed. It is the income tax department that tells you what categories of mutual funds will enjoy what kind of tax. It doesn't really say category. It tries to define it in terms of equity. So when the equity allocation of a fund is more than 65% in domestic equities, they are classified as equity or equity oriented fund, and they get taxation like any other equity, which basically means that you will be taxed at 10% if you hold for more than a year and 15% for less than a year, right? So the other thing that it says is it brought in, so that was the whole discussion. In March, it brought in a category where it said when the equity allocation is between 35 and 65%, you will get indexation benefit. So debt funds were removed of indexation benefit, but indexation benefit was given here, and it says that if you hold for more than 3 years in those categories which have equity between 35 and 65, then you will get indexation benefit and be taxed at 20% post such indexation. Of course, less than 3 years is taxed at your tax slab, right? Now, the other thing where debt funds, your conservative hybrid, your gold, or any other category where the equity allocation is less than 35%, they will no longer get indexation benefit, right? So essentially what happens in these cases that you will be taxed similar, to your other debt investments. Actually, that's what happens in this case. So this is why many of you wanted to have a better substitute for your debt funds. So we'll get into that discussion now. Now let us try and understand which categories, what taxation will apply. So SEBI's definition of requiring minimum 65%. Okay, that categories are equity, hybrid aggressive, arbitrage, and equity savings. So in these categories, SEBI very clearly says you should have over 65% equity, right? For this purpose, having derivatives, equity derivatives, the index derivatives, etc., is considered as equity. And therefore, if you're an arbitrage fund, if you're an equity savings fund holding derivatives, and also these hybrid aggressive funds, all these need to have this minimum 65%, and they qualify also for being a equity fund for tax purpose, right? Now, SEBI does not state what proportion of equity you should have in balanced advantage or dynamic, asset allocation funds. By and large, most of these funds, along with derivative exposure, have thus far held over 65%, which means they also get this equity orientation benefit under tax. But please remember, a fund can say, no, I will not be holding 65%. I may be holding between 35 and 65%. In fact, recently, when Parag Parikh launched its dynamic asset allocation, in one of its presentation, the, CEO has stated that they will hold somewhere between 35 and 65%. They will hold less equities, right? Which means they will get the benefit of indexation, right? There is also another category which gets this benefit of indexation by way of SEBI's definition. That category is called balance funds category. Thus far, we never had, or we had like just one fund or so under this category. Now, more fund houses are beginning to launch this simply because this definition says you can hold 40 to 60% in equity, right? So if you hold 40 to 60%, and they should not use arbitrage, so no derivatives, they will get indexation benefit because they will also qualify for the tax definition, right, of holding 35 to 65%. So here it's 40 to 60. The taxman gives you a leeway of 35 to 65, which means balanced funds will also qualify. So just to recap, the hybrid aggressive funds, your balanced advantage and dynamic asset allocation, a majority of them, not all of them, your arbitrage funds and your equity savings funds all qualify for equity oriented fund under the income tax. Now, there's also another category called multi-asset, right? Multi-asset, SEBI does not define. SEBI simply says you need to have a minimum 10% in each of the asset categories. So you can hold 10% in gold and 80% in equity and 10% in debt, or the other way around. You should just have minimum of 10%. So here, unless the fund clearly states in its own, scheme information document, or it has internal policy of holding X amount in minimum in equity, we can't be sure that it is an equity oriented fund. And this is where it's a gray area. So when you observe a fund, you basically need to see over the last several months or quarters whether the fund has been steadily holding higher proportion of equity or higher proportion of debt or so on, right? So this is one area where you cannot directly claim superior tax benefit in terms of equity. Still, you may be able to get the indexation benefit. It's possible that it falls as an equity fund for tax purpose, or it gets indexation, or in rare cases, it becomes a debt oriented fund also. So this is a go anywhere fund as far as taxation is concerned. Now, so these are broadly, where the categories of funds will fall under when it comes to taxation, right? I only spoke of taxation. I haven't spoken about the risk element of these hybrid funds. Now let's just take a look at it. We have tried to classify here the worst returns and the standard deviation, the instances of losses in various hybrid categories. As you can see from the data, needless to say, the hybrid aggressive is among the worst in terms of no, losses, it suffers, the proportion of losses it suffers, and its volatility, right? Multi-asset funds come next. Contrary to what people believe that, because of moving across asset allocation, multi-asset will be able to contain, not really. Most of the multi-assets have been equity heavy. So you see that their volatility is much higher. We have just constructed a 50-50 equity debt index because we don't have this balanced category with sufficient track record. So we created that here. These are all based on rolling 1 year returns over the past 5 years. You will see that progressively the volatility and the worst return numbers come down. The last two categories are debt, just so that you compare them with the hybrid. You will see that arbitrage comes somewhere close to debt in terms of its risk profile. Obviously, its return profile is also not that high compared with other hybrid funds. So the least here you can see is arbitrage, then equity savings, then balanced advantage dynamic asset allocation, then comes the balanced category, and then there's multi-asset and aggressive. So this is the risk, and you will see other than arbitrage, none of them measure up to debt funds in terms of their risk profile. And this is what I mentioned in the beginning, that when you make a decision based on taxation, you are essentially changing the risk profile of your portfolio. So you need to be very aware of this. I'm not saying you cannot take risks, it is up to you. But when you switch, you are not serving the purpose of debt. The purpose of debt is to contain this volatility when equity is not doing well. That will not be fully served when you use these hybrid categories. So that's something that you need to be aware of, right? So that's what we have summarized here. And aggressive and multi-asset. Multi-asset is definitely not an asset class that you can use as a substitute for debt. They are meant for the long term, right? So whether they can be used as a one fund for all asset classes, that's a separate discussion we'll talk about later, right? The other thing is whether this 20% indexation, whether it is really a boon. We actually don't know. The 20% indexation can be a very good thing if you are having a high inflation period, right? And it will also depend on how this balanced category as such, or the newer dynamic asset allocation like Parag Parikh with less equity, how they will perform, right? So the performance and the inflation index being favorable, you might actually see that this 20% indexation may work for you, right? Um, so here, for example, we made some assumptions here. We made an assumption of the cost inflation index, and we took, 50-50 equity debt portfolio. We tried to see what worked best. Um, so we in different tax slabs, it was working differently. So here, just so I can read this out for you. When we assumed a cost inflation index of 4.9% for the past 3 years, it turned out that equity and debt portfolio did better than the balanced fund on a post-tax basis for the 10% and 20. That is, if you kept your equity separately and debt separately, your equity would enjoy the equity taxation, your debt would have only the debt taxation. Neither of these will get indexation, and yet they actually did better, right, with the inflation that we assumed. But then again, the 30% tax slab, it was slightly different, right? The balance fund did like 0.47 higher than the separate equity, separate debt. The point that I'm trying to make here is you don't have to disturb necessarily the separate equity and separate debt that you hold for the sake of taxation and move something to a balanced category, right? When you choose a fund, you might want to introduce low volatility, therefore you introduce a hybrid. That is a different, call altogether. Overall, in this, the message is that you cannot make a decision based on taxation alone. There are cases where just holding equity and debt instead of a hybrid can actually deliver better despite lower, returns, post-tax returns from debt, because indexation is gone. Much would depend on the nature of the product. So keep that in mind when you take these decisions. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.